Okay, can you hear me okay? Okay,
Cool.
great. So thank you very much for coming to join us in the Solana Sanctuary, can we call it that? Here today to talk about Think Tax Fireside Chat with myself, Dion Seymour, and Ben Lee.
That's me.
So, Andersen, we like to help support the community, and we're very pleased to be here. So, thank you to Solana team for inviting us to come and talk about Think Tax. Equally, we've contributed to the Solana's legal playbook with a chapter on taxation. So, we are no strangers to engaging with the Solana ecosystem. So, thanks for closing that door. So, today, we're going to talk about the taxation side of things. Now, for those of you in the audience, I want to ask a quick question. How many of you have considered the tax for either your businesses or for any of your users? Not you, James.
This isn't a test. You don't have to put your hand up. No one's going to get scolded if not.
Well, I think it's easier to see. I like audience participation. So 1. Is that at 2?
We've got 2.
No. Okay, maybe 2.5. Okay, so as a wise person said, tax accountant might not be sexy, but it's important. Don't know if I should repeat that fully, but we do need to think about how this actually interacts with not only your businesses, but those who actually use crypto. So that's my starting point. Ben, do you want to?
Yeah, no, I would say that, and the kind of consensus here in the room has kind of agreed with that. There's a lot to think about when we're building a project, right? It's right. What are my aims? What are my goals? What am I building? Right. Okay. What can I do? Where can I do it? What are the regulations? What do things look like? And often, understandably, from a priority perspective, these things come quite low down. But of course, the implications of not getting these things correct, sadly, can have quite large ramifications for projects. No one wants to suddenly get a tax bill they weren't expecting, or an HMRC inquiry, or various other things that are just going to delay what we are trying to achieve. So it's quite important to understand a number of things in this space. And whilst, as Dion said, Think Tax is probably the least exciting thing anyone has said, those 2 words combined today, if not in all time, it still makes it quite an important topic to talk about.
No, thank you for that, Ben. So we want to talk a bit about the tax and accounting. What we will not be talking about is regulations. I hear you had about 20 lawyers here yesterday. So they would have covered all you needed to know about regulation and more than we could ever touch on. So we're definitely not going to touch about the regs. The regs are important, but just not our field. So when you actually then come in to set up your projects, I'd like to, again, ask quickly for the audience, those who did put your hands up. Why is it that you thought about tax? Just quickly.
Same time I run startups before, so.
So you've been burned.
Okay, cool. What did you think about tax?
Because I didn't want to pay it.
You mean you don't think about tax daily like we do?
Okay, so interesting responses. So you might have been burned before, and 2, you want to somehow not pay that. So unfortunately, tax does need to be paid. Quite the quantum of it is what can be sometimes questionable. You can sometimes overpay, and sometimes you can underpay. And when you do underpay, that's obviously when you've got more concerns with HMRC knocking on the door with a dreaded brown envelope attached to any inquiry notice there, so coming at you. But equally, accounting. So accounting actually has to really start quite early on in this process for the forecasting aspects as well. So
yeah, absolutely. And I don't doubt that's something we're going to delve into in more depth later on today. But again, when we come to think about the priorities and what we need to think of, I appreciate because of with what we build in Web3, there's the sense of obviously all the on-chain transactions are going to be recorded, and maybe that's okay because we know stuff is happening somewhere and we'll just get that when we need it. But there's a lot more considerations to think of than that. There's so much data, both on-chain and off-chain. And this becomes really important for a number of reasons, not only to really know, where we are in the stage of our life. Obviously, let's say we've got some funding. We need to know, what is our burn rate? How long have we got to last? Do we need some more funding? What are the future costs? What's the build, right? What's happening on chain? Where is our value? Is it in fiat? Is it in stable? Is it in whichever token we may have? And how long is that going to last? And what value can we rely on there? So finances for me, so double sad because I am both tax and accounts. But for me, it's very difficult to kind of understand where you are in your business's life without understanding the financials, because that will literally tell you all the information you need to know and is another measure of success. There are obviously lots of different measures of success out there, but for me, those finances are the biggest enabler to understanding where you are and effectively what the future looks like.
And on that financing forecasting point, again, I do like audience participation, particularly with such a small audience. Who here has actually tried to build that? You must have done business plans, particularly when you go into your investors for any angel investment and so like. So everyone's used to thinking about forecasting and cash flow, because I guess your investor's going to want to know how they're going to get their 100x out of your project. So I would guess that hopefully we should see more hands here when you've been doing your plans for your project. You've taken into account some form of forecasting. Okay, a few, three, maybe not. I'm loving the honesty. It's like, yeah, no, if I make money, I do. If I don't, no.
Forecast, meh. Tax, meh. Like it.
Project, hopefully.
Yeah. I mean, it's really on the investment point. It's obviously quite important, depending again on what stage you're on. But the first thing they're going to ask for is some financials. Okay, what is on your balance sheet? What do things look like? How much have you got right now? And how long is that going to last? But I mean, to put things in perspective, we have projects as well that we work with that are hugely successful, which also still have never put financial information together. And they've got their investors saying, well, guys, we need some information. Like, we've seen publicly that you are doing very well, but we've not been sent any kind of management information. We don't know what's going on. And obviously, yes, we got involved because we're expecting a return. So where are your financials? So it's not only useful both for obviously obtaining the investment in the first place, but obviously keeping investors happy, making sure everyone is aware of what's going on and up to date.
And that's obviously no surprise that we can help you do your financials. So those of you in the room who haven't done them yet.
We do have breakout sessions later, right? Come and have a chat.
Yeah, we do.
Come and have a chat with financials.
Absolutely. And can I just say, if you do have any questions as we go through, do feel free to shout up, go as we go through. It's always better when you feel that you're talking to people rather than talking at them.
I mean, we are still people. We do tax and accounts, but we are people, just in case of, for the avoidance of doubt. And we're actually all right. I think we're all right as far as accountants go.
I did 20 years in HMRC. Take those words out of your mouth.
Okay, I'm sorry. And this is why you are going hard on the audience participation to try and run down this hour as quickly as possible without having to talk too much about the HMRC side of things, I presume.
No, I'm just better used to when the fact that we've got pitchforks and burning torches
also
in the hands.
True. I feel like you let that out of the bag too early and given them enough time to go and get pitchforks, though. So if anyone does have a pitchforks in-house, then now would be the opportunity to go and get it.
Yeah, I checked the local Tesco's. They don't have any pitchforks or torches.
They might have brought them from home.
So I'm good.
Okay, fine.
Garden supply stores are nowhere in the vicinity.
So whilst we brought that cat out of the bag, is that something we should talk about and dwell on? Let's talk about it.
I was building on the financials accounts, and then we can move on to the tax.
Okay, you've got a plan. Cool.
I have a plan.
Fantastic.
So moving on to the tax now. Again, businesses and individuals are both going to get affected by tax here. So we've touched about some of the businesses here briefly, but your users. Now, this is one I always find interesting. So you're going to be creating something for users generally to use or do something with, which may or may not be a token of some variety, could be something else. Have you considered here, again, any thoughts on the tax from an individual's perspective? So, you've talked about your stablecoin platform, so you've clearly thought about the tax here. But did you think about how that might impact on your users? Because surely one thing which I'm always keen on understanding is a bad tax experience for your users might be seen as a bad tax experience for your project.
I'm pretty sure we have risk warnings in the platform that says you are not responsible for any of your tax liability.
Pretty sure sounds like 100% confident to me that you have, so that's fine. Okay, cool. Satisfied.
Cool. Yeah, we're definitely Yeah, no, we don't want to take people like that. We anybody else.
Okay, because obviously the danger is, and I've said this too when I was in HMRC, which I will touch upon a little bit.
Oh, you hadn't mentioned that. You're
No,
HMRC.
no.
We didn't take on that. If any of us stop, everyone's a contractor.
But
Tumbleweed.
no, how are you trying to pay less tax if you got? I'm responsible for nothing. That sounds like a somebody else problem now.
You're like, I wish I hadn't talked to these guys before they started, right?
So threw me off. So one thing which I had to mention to exchanges, if your customers get hit by tax bills, it might stop them actually wanting to invest. It might stop, in crypto. It's going to want you to stop there, and that's where they've got to rely upon the fees. And so if they then have a negative perception of that, then it stops their behavior. Then it's not particularly helpful. So anyone here, again, show of hands, who has anything that might be taxable in the hands of the users, or all your projects. Now, we spoke about your NFT project. If I can throw you in here. Well, not so much NFT, giving things away. So you've got things that could have some value. You're giving them away. Have you got any thoughts about how that might impact on the users without owning these things, and what happens with these things that you give out?
They end up having some values.
Yeah.
Well, I believe it was a year taxable, then there was an added value because they had to work for it. So it wasn't necessarily an airdrop, which is a free claim, not taxable in the UK.
Mate, get this man a microphone and get him on stage. Absolutely.
So it's up to the collector to disclose. I mean, it's only taxable event if they sell it, right? Well,
Yeah.
So if there's a capital gain, they would have to pay tax on capital gain.
Perfect. Gold star. This is what I'd like to see. People who are actually considering what might actually happen to the users on that taxable event. Yeah. You have the risk warning, but you had the right answer. If they're not doing anything for, as in creating or an income-y type generation. They're going around scanning things, they're getting it rewarded to them. That would be fundamentally a free of charge airdrop because they're not actually providing any value to the operation. Subsequently to that, then yes, if it goes up in value, then anything they sell it for would be taxable on that difference between what the market value was when they received it and the value of it at disposal.
So how do you put a market value on something?
Wow. Here's a trick. So
Is it zero?
would it be zero, or is there something else to it? So that becomes another consideration. So straight away, we are now entering into some questions as to how does that get dealt with for tax. So even though you've considered very, very smartly and very well the implications, there's also some other nuances that might actually impact on the taxation side.
You also recognize the best free tax advice out there, which is you only get taxed when you sell. If you don't sell, there's no tax.
That's because I'm a repeat bad
So tax might appear in somewhat surprising ways. Even if you do know the tax consequence, you might not know the full ramifications. And, like we talked about the valuation there. So Ben, when we're then talking about think tax at the moment, what would you say is one of the main things that people should be watching out for think tax?
So you may have heard this before, but we consistently get a number of individuals that still don't fully understand the rules, perhaps, and don't consider that crypto to crypto is taxable. A lot of people think, right, when I get out of crypto and I've made my money and I've got my cash, that's when I'll pay tax. And that makes entirely logical sense. Why would you get tax if you don't have the money to pay the tax? Well, unfortunately, the rules. And the rules effectively say that when you dispose of an asset, that is a tax point. So when you might be sort of, skipping around between tokens to tokens, swapping them on whichever DeFi exchange you might be doing or anything else, all of these creates tax points. And those tax points become very important because if you never, let's say within 1 year, and we've got a couple of clients that have done this and have become very wealthy out of day trading, but they consistently keep all of their assets in crypto. They don't ever off-ramp. So that means within a tax year, which goes from 6th of April to 5th of April. What they're doing is amassing wealth, but creating all of these tax points along the way, which leads to a tax charge. But they don't have anything to actually pay the tax. It's what we call a dry tax charge. No one likes a dry tax charge. Weirdly, there's no wet tax charge, I don't believe. But this is a very dry tax charge. And obviously that can be very difficult. We've probably all lived through the market changes is such a nice word to call it, over the last, God knows, 8 years more. Where are we in the world, 2025? It's probably accurate. But certainly if we look at the boom of NFTs, 2021 to early 2022, there's lots of people out there that were doing very well off minting NFT collections, selling NFT collections, utilizing NFTs. And obviously they gained a lot of value, predominantly in ETH, but then the bottom dropped out of the market later on in 2022. And the problem you had there was they created a lot of value on which the tax charge was based. But because they didn't off-ramp or didn't keep anything in stablecoin, their tax liability proportionate to what the value of the wealth was obviously increases massively, because if I'm selling everything here and I'm racking in the ETH, and then suddenly this is my tax point, by the way. So when I receive those tokens for selling something, the value when those tokens are received is what matters for tax purposes. But then suddenly if what I'm holding is worth this, but my tax is worth that, well, it's going to erode my asset base and actually the value that I've got in my project considerably larger than obviously if it was more stable. So, sorry, you asked me, I think, quite a simple question, and now I'm diving down the rabbit hole of all of the things. But I think the thing to consider here, and I would say this, is data. Because being in crypto, being in Web3 creates a lot of data points, which are of huge significance for tax purposes. It isn't sadly a case of, well, I started here and I ended there, tax me. That would be awesome and wonderfully simple, and we probably wouldn't have jobs. But the sad reality is that we do need to track all of these things. We do need to track that data because each transaction has an implication. And if that isn't considered accurately at the time and proactively, dare I say, that can lead to some really unwanted surprises for tax purposes.
Agreed. And actually, data is where I thought you were going to go, but I'm going to do a quick fun quiz again because I like doing this to back to the audience. Fun quiz.
By fun, do you actually mean fun, or do you mean like Ben and Dion fun, which isn't actually fun?
Okay, Ben and Dion fun.
I feel like the tax fun. Like, is there such a thing as tax fun?
My fun. Okay, owning stable coins and buying and selling stable coins. If you hold it in stable coin, do you think if you sell a stable coin, you're going to create a tax charge? Show of hands quickly again. Do you think selling stablecoins can create a tax charge? Not you, James. So I want to come to you, but I want to pick on Cap first because you look so hesitant there for a second. Why do you think so?
Well, because technically it still does change price ever so slightly, even if it's tiny amounts. So there's probably a different price at which you got it at to which you then sold it at. There is a very slight discrepancy, which there could be a tax charge on.
So that's why you were doing that at me.
Yeah.
Okay.
Shut up, Dion.
just checking. You were looking at me going,
no one wants your fun tax
That's why
games.
I had to go to this. I'm like, okay, this, I'm really intrigued. Why are you sat there looking at me going, okay. Or you're doing it in the distance going, squashing your head. So actually, it could create more than that. So we have in the UK a functional currency of sterling. Now, most stable coins are in what? The dollars. So if the pound falls against the dollar, you actually create a taxable gain without even realizing it. And we had that during the Liz Truss mini budget when the pound started tanking and people were making great big gains just by selling stablecoins. Free advice for you to think about for your stablecoin platform here. So it can actually create an impact that you don't necessarily realize. Now, I did expect Ben to say data a minute ago. So Ben, ignore my stablecoin question. So the data can be quite problematic. What can Andersen do to help here?
What can we do to help? Oh, Dion. So it's a really interesting one, right? So of course anyone can go online and get their wallet data and go onto block explorers and do that all manually, but there's a lot of softwares out there that can do that job for you. What we do is we utilize a lot of these softwares depending on individual needs. And they are very good at getting the data, compiling the data, and in most cases, giving accurate pricing values for those transactions as well. Now, the problem is most of these are cloud-based softwares. So We need to think about transaction volume. You know, if you're doing 1,000, 2,000 transactions a year, happy days, it's going to deal with that quite well. Tens of thousands of transactions, probably still okay. Hit 100,000 transactions, you're going to have a bad time. It's too much data for these softwares to actually handle. So this is kind of a cumulative effect. So let's say you were doing 20K transactions a year. Okay, in 5 years' time, you'd like to think that it's got a bit better in terms of its capacity to handle that. We haven't really seen that progress yet. And we do have clients that do significant numbers of transactions. I've got a client who's written a number of different algorithms that is executing about 6 transactions a second. And I think in total over a year, that comes to about 200 million transactions. So there's different approaches for different needs. But a lot of, we come back to data again, right? So we will utilize different APIs, whether that's with exchanges, whether that's directly with whichever chain the activity might be happening on, to pull out this data and aggregate it. And as I said earlier on, it's good at getting the data. It is not currently very good at analyzing that data. It'll give it its best shot, well done. Work as hard as you can. We don't expect any more of you. But leaving it there doesn't give you the final answer. So when it comes to data, there's lots of things that will just go, I don't know, it's maybe this. And if you don't go back and be like, maybe it wasn't, it's going to be wrong. Typically, this will be whether there's a certain area of judgment. Let's say you're interacting with a DeFi protocol. Have you lost beneficial ownership of your tokens? Have you not? Don't know. It might depend on the platform. If you're batch buying NFTs, it's going to have a hard time at attributing kind of a cost to those individual NFTs when you go and sell them. So I got excited about that one. Sorry. So there's lots of intricacies to understanding the data that needs to be understood for that data to be correct. And if I was going to put that into an anecdote, one of our clients was very big in the NFT space. He came to us from another advisor, holding themselves out to be a crypto specialist. And what we do when we look at the data is always just check that all the data is accurate, so that when we start going forwards, we're not that there's not like a big black hole missing that's going to cause us issues going forwards. And anyway, we basically went through, found a lot of transactions that weren't correctly analyzed, a lot of wallets that hadn't actually been included because like it's typical, right? Like you and me, we probably dabbled with a bit of crypto, but not successfully. That's why we're here talking about tax. But we will go, we've got like 10 or 11 wallets. And in actual fact, we've utilized like 50, 60 wallets over that time. We just forgot about half of them. And that's not uncommon. But if you're not including all that data, it's going to, again, assume you've got rid of something when you haven't. But going back to this client, basically we looked through all that data, we sorted all that data, and we ended up saving just under about £1 million of tax payable because the data was incorrect. And that's a significant amount of money, obviously. But that kind of, and once the magnitude is big, the likelihood is in these instances, you're probably likely to be overpaying if it's got the data wrong because it's going to think something is a disposal when it's not. So just putting it on these softwares, fine, cool, it's going to give you a picture, but that picture's not going to be accurate. So sorry, again, the data is hugely important.
So, James, what are we doing about the data? You're talking about that later, aren't you?
I'll give you the full load out on the data later.
Spoilers, Dion, spoilers.
I know, but I'm just trying to create interest for the session later. So we will be talking about...
Was my speech not enough?
I was going to create some interest.
Real examples of how these issues occur, how you can get around, these issues occur, making sure that the person giving all the information to has all the information they actually need, but also the job that you can do of keeping track of the data is not good enough to just say it's all on chain, it's all there, we'll find it. Because in 2 years' time, when you put it in your account, you will not remember where those transactions went, who you paid, or where when
Yeah.
And something else I would add on to that as well. Sorry, I don't know how we're doing for time, so hopefully I'm not hogging the mic too much. But it's all about proactive information, right? Like everything that happens on chain happens in real time. I would say this, but tax advisors, we generally like to get the end of a tax year and we go, oh, cool, we got to the end of the tax year. Can we have your stuff? And that means then having to go through a year's worth of transactions, which might be in the thousands, to turn around and go, hey, this is what your tax position looks like. It's kind of like a deal with it at that point because there's nothing you can do. That's just what what the situation looks like. A tax advisor is saying this happened. One thing that we certainly do, and is obviously good for any kind of person looking to take an active interest in what their portfolio might look like, is make sure that data is up to date. You know, it's kind of weird, like you do bookkeeping for companies to understand where the financials are, and what, when we were talking earlier on about making sure that, you know, you've got enough funds, or what the investors might want, and actually what that picture looks like. It's certainly the same when it comes to personal investment, because let's say, for example, a US president then goes and starts a tariff war and all the markets start dying off. Suddenly, actually, the position changes quite rapidly. And suddenly, maybe I'm sitting on losses that I hadn't realized before. And maybe some of these projects aren't going to recover. What do I do? Do I actually sell to take a tax loss? If I do, then I presumably have to wait 30 days to buy back again. What's it going to look like in 30 days? Could I wrap those tokens and take a tax loss? But I'm not able to do any of this proactively unless that data is up to date. And with up-to-date data, you can actually get proactive tax advice on what is going on in your portfolio to make sure you are making it the most tax efficient as possible.
Absolutely. So now we've covered a lot about individuals and their taxes, but I'm sure you're all crying out, what about me? What about our project? Did I not time that well?
No, I just wasn't hearing any crying out.
Yeah.
I'm sure people are on the inside.
So what about your projects? Do they have anything you need to worry about? Well, I did hear someone saying earlier that they don't worry about the tax risk about their contractors, but is someone really just a contractor? So we start getting into some areas here where you do actually have to start thinking about how you plan your business and how you plan your affairs and how you comply with HMRC. So it's quite common for people to be paying contractors, but Ben, is it possible for a contractor to be an employee?
No, I've done too much talking, Dion. I'm happy for you to talk about this. You can talk about this.
Okay. Are you trying to escape this?
Yeah, I'm thirsty.
So just picking on this one for a second, it is possible for a contractor, depending on how the terms and conditions to be considered by HMRC to be an employee of the company. It's what they call disguised remuneration, and so they are very hot on this in that sense. It's sorry? Yeah, IR35. So yeah, most people do, but just highlighting some of the challenges that you might have in the space. So clearly you've read some of the IR35 notices. So it's something to you need to be carefully be compliant of. But equally, we've also got a whole host of other things that that you have to consider. So if you are paying yourself, which most of your projects hopefully you will be, you still have obligations to report to HMRC. So you have to make sure that, particularly if you're trying to do a PAYE scheme, that that's all being done and done correctly. I've been trying to catch Alice's eye for a little bit.
No, don't look up, Alice. Don't look
at Alice.
Alice is trying to rope you in. Alice is Dion's trying to. Which one is which? Dion's trying to rope you in, Alice. Just stare at your laptop. Look down.
I was going to say, Alice will be talking a little later on about some of the things that you need to be compliant to HMRC. So payroll, for example, as well as fun things like VAT. So some of your things will be generating a taxable supply for VAT purposes, and so you will need to consider whether you need to register for that. So Alice will be covering that side.
Yeah, I was gonna jump in on that. So sorry, after being like, you talk, Dion, I was like, no, I think I have something to say.
No, Ben.
It's an interesting point where contractors might be based, though, right? Because crypto is global, and often a lot of the workforce is global as well. That does open itself up sometimes to further risk. Like if you got too many people in one country, and do you have a branch risk? Do you have a permanent establishment over there? Are we then having to think about how we then mitigate having a tax obligation in a different country, or what that tax treaty might look like? But there's also things. Has anyone here heard of R&D? I'm doing audience participation now. How the tides have turned. Has anyone here heard of the R&D scheme? I'm putting my hand up. I would. Yeah, James. Right. But obviously this is a incentive for anyone undertaking genuine research and development. And typically that means, right, we're looking to do something new in a scientific field. And sadly, one of the key factors of it actually being kind of research-based is it failing. And whilst you might think, well, that's great, but there's a lot going on in Web3, and what I'm doing isn't particularly new, it's kind of a nuanced aspect of something that has come before it. That doesn't necessarily mean that you can't claim R&D, but trying to cut a very long story short, R&D is an area where you can get cash incentives back into the business by performing research and development. But things like where your workforce is based, it's an area which was very let's say, loose, and HMRC are certainly cracking down on erroneous R&D claims to make sure that, claims that are going in are genuine. They're also kind of cracking down on what UK businesses are able to claim as part of that R&D scheme, with very much a focus of that R&D being undertaken in the UK. And there are further considerations that need to be made. So, right, you might be contracting or engaging with people that live in the EU but aren't incorporated, working on their own, and even small details like that can then affect whether actually the cost that you're spending is eligible for R&D. So, one thing on its own in isolation, you might think, oh, I've got a contractor, they're not an employee, that's IR35, and that's what I need to think about. Actually, it can kind of then feed into a whole range of other taxes without potentially realizing it. Sorry,
Brilliant.
thank you, Neil.
After all of that, he wasn't going to say anything. He did. So I want to start drawing us to the end, because I don't want us to be taking the full hour, because we would like to also highlight, we've got James and Alice also going to be talking about a load of other things, a lot more operational. We've taken on a bit of a journey here. So we've started out highlighting, actually, some of you have thought tax, some of you haven't. Forecasting is important, not just for the tax side of stuff and the accounting, but also for investors, so they can actually see when they might actually get some form of return on that. Some of the ideas about trying to help for your projects, as well as some of the ideas to actually help with you yourselves with your projects. So I think we can bring that towards a close.
Yeah, absolutely. And I think just dwelling on those two very unexciting words when combined together, think tax. We're not saying let it consume your waking life like it does ours, but just make sure that you have thought about it, or you've talked to someone, or you've got some advice, just so that you're aware of all of the things that do affect you and what those obligations might be, because it's certainly worse further down the line not having considered them than considered them. Hashtag think tax.
Oh, we've got a question. I was going to say, any questions from the audience, but.
Because when you talk about are you eligible and stuff like that, a big part of Web3 projects is you have offshore companies. So if I was to launch a token, I'd set up my BVA to be the issuer, to do my Cayman, to be the foundation, and then I would maybe have a sister company that does services. That's how I can go through.
Yeah.
So when I'm doing an offshore, and it could be a whole host of different offshore things, I could have my company set up in Dubai or Singapore, and that I'm based here in London. So what are the implications for British founders when they're building this industry and having offshore entities and things like this? What are the key things they need to know and be aware of for when it's when I do this, I'm now paying into UK taxes?
Sure.
Yeah. So we've got a lot to cover there.
Yeah. So firstly, I would say, sadly, I'm not the right person to ask about that question. And actually, one of the co-partner, who heads up the crypto team at Andersen, Zoe, has been doing this for 20 years, right? This is completely her bag and something she should be answering. And if she watches this or is watching right now, she'll probably be throwing things at the screen based on the answer I'm about to give. But you're right. Typically, for a UK founder, you have to have an offshore structure. Why? Regs. So a lot of people will go and try to understand how they go about doing what they're doing. And a solicitor somewhere will say, right, well, you can't do that in the UK because of the position here. So you're right, go and set up a BVI company for a token issuance, or a Cayman foundation for the decentralized element of the project, etc. Right? So the problem being in the UK, and it depends, I guess, if all of the founders are in the UK or if they're more widely dispersed geographically. But if we focus on being, you've just got a team in the UK, the first implication is cost, right? This isn't cheap. To go and set up offshore entities and various other things, there's a cost associated with that. You need directors and people to look after those companies in those presence there. That also comes at another cost. So the first barrier to getting all that and how much that looks like. But secondly, we've got over 100 years UK to stop people going, hey, I've earned lots of money. I'll just stick it in my BVI company. It can own all my London properties. Happy days, tra-la-la. My name's Jimmy Carr. That's not what he did. Hopefully he's not watching either. Sorry, Jimmy. But it's that sense of when will it hit the UK, right? So typically, if you do have an offshore structure that is getting revenue due to token sales. At some point, they flow back into the UK for tax purposes in any case. But it's offset against the development costs and various other things that entity is then providing to the offshore company. So you've got a case of, yes, there will be profit, but they're being matched off against the expenses that the development company is taking. So when everyone thinks, oh, that's great, let's go offshore, it's not for tax purposes. It's not for tax purposes if you're a UK resident. UK resident individuals, companies, you're taxed on a worldwide basis. There's no way of escaping that. The worst thing you can do is take bad advice and go, oh yeah, Joe Bloggs just told me to go and set up a BVI company. It's cool. I'm director and I'm shareholder. Well, if you've got that and you're in the UK, then any money that BVI company makes can be taxed on you personally at 45%. That's half of whatever you've raised just gone instantly. So consideration absolutely needs to be applied. It isn't a get out of tax free card. There will still always be tax implications if you've got a UK-based founding team. It's more around the timings of when that hits UK tax, essentially. I don't think I did Zoe a disservice, did I?
No, absolutely right.
Fabulous.
You just didn't say management and control, which is a big problem there.
All right. Go on, management and control. Off we go, Dion.
The reason why it could it onshore is that there's a very old tax case that looks like where the management and control of our business was. It's actually De Beers, diamond mine. And although it's being operations were out in Namibia mining the diamonds, all the decisions were being made in London. And so the Inland Revenue, as was at the time, took them to court and said, well, because all the management control is here in the UK, it's a UK company. And so that's your problem there with being a director if you're going to do the BVI entity, and the fact that you are the one who's doing all the decision making for that BVI entity, then it's quite simple for HMRC, pragmatically simple for HMRC to say, actually, you're the controlling mind, therefore it is being run from the UK, and then brings all those profits into the UK up to the 45%. So that's a challenge.
And that's the same principle, effectively. Let's say if you had when we were talking earlier about having lots of contractors based in one jurisdiction, let's say I had a project, I'm in the UK, but my entire team are in South Africa, and I'm flying over to South Africa to meet with them and make the decisions. The same issue arises, because really, is my entire economic presence in South Africa? Do they have a right to tax anything that I'm doing over there, et cetera, et cetera?
Answer your question, Cap?
Say within the offshore entities and stuff like that, should you then be doing it for a UK company rather than yourself personally?
Well, yeah.
That should be like a hard block to be able to make sure that there's extra protections.
Well, I think I don't want to talk about the regs, but I think the new regs, as you've seen, are going to require a lot more of a UK entity. Our branch isn't going to be sufficient for the new regulations. It is looking like you're going to have an actual UK licensed or regulated company for the under the FCA to be able to provide to UK customers directly. So I think some of that is just going to become a bit more of a moot point, and you might have to have that UK entity to have UK customers. So
is there any piece, so when I then have this like UK company and I myself personally around it, you see traditional mechanisms of paying yourself dividends and then being able to get into that. Are there any other like pieces of smart structures that can be set up, from trust funds to like I'm saving into this account, so the money's not going to me, it's going to my kids, or different things like this that then allow you to take from the company into personal in a smart fashion, thinking about that.
I was going to say, our combined deflated there might have given you a sense of the answer, but I will let Dion.
Okay. Simple answer, no. No. When you start going down these routes, there are many ways that people have tried to hide remuneration. You've had the old providing loans to a trust, and then that trust apparently, providing funds from the company to a trust, and then that trust gives you a loan that meant to, it's just a loan, I'm never meant to be paid back. All these type of things have gone through the courts. You've seen potentially some of the news around those things where they're just saying, fine, if you've got an outstanding loan, you've got to repay it back and pay the tax upon it. There have been never-ending, and I don't think they ever will end, attempts to circumvent the UK tax system. the more aggressive it is, the more likely you're going to get a HMRC response saying that money you never got and was gone to your kids. You can do a salary sacrifice for yourself to your pension. I've not really come across a salary sacrifice for your kids. And I think they'll probably look at it and go, doesn't really fall within providing to a defined pension scheme, because there isn't really a mechanism to do that. So I would say no. Ben?
No, I agree with you. I would say that net has really closed down in the last sort of like 10 years, right? This idea of some sort of sexy tax planning that actually works to structure things more efficiently. I was going to use the word loopholes, but I think any availability of that, certainly within the UK, has become more limited. It certainly feels like it's ever been. But I would say, where you've mentioned, obviously, the forms of remuneration are typically salary and dividends. One of not to overlook is obviously token agreements, whatever they might look like. If your project is involving, starting its own token, actually the timing of how founders might get their token allocation is really important. Because if they make sure that before any private investment round or any other further SAFTs or agreements are made, if they lock in to their token agreement early on, so obviously if you to value that token, it has incredibly low costs because it's probably typically linked to what costs have been incurred in creating the token. If you actually then buy that token value, which is going to be very small, kind of locked in that acquisition, you've got no further tax consequences until you come to sell your tokens. And this is before the tokens have been generated, right? Like we are buying future tokens ourselves at a low market value price. And the reason that timing is very important is because as soon as I come along to Dion and be like, hey, Dion, do you want to buy Ben coin? It's going to be amazing, but I'm going to sell you X tokens for whatever. That then sets a new precedent for what that token is worth, because there's an active market, I say an active market, but it's benchmarking my token in terms of what someone else is willing to buy it as that third party. And we see a lot of people that kind of are very focused on building the platform, getting to TGE, post TGE go, fab, we'll get our tokens now. And there's no way to get that tax efficiently because you're not buying them. The tokens probably have the highest value at that point than they've had to date. And taking that as founders and being connected with the business is just going to come with tax complications. So that's another method of looking at obviously your remuneration and involvement in the project, right? And all that sort of stuff. But the timing of that is crucial.
Just on that example of getting tokens earlier, am I getting the capital appreciation? Like I'm paying capital gains tax when it goes up, but if I buy at the top, and then I guess I take the loss.
I see what you mean. So obviously you're going to end up with less tokens, right? Depending on whatever funds you have available to you. But what we often see is people not buying them. They'll just go, right, we've allocated these tokens, or we're giving them to staff, we're giving them to employees. Like if you're giving them out, that's remuneration, that's taxable under income tax. If you're taking tokens or a company is distributing tokens to you for free, again, it's a form of remuneration, it's income tax. So the idea being that actually when you do choose to buy them, you're buying them at the lowest possible value, ideally, so that you're right, you get that capital appreciation all the way through, which is only taxed at 24%, as opposed to getting them day one, but you're probably going to have to sell 47% of them to cover your tax, say.
Yeah. And part of the idea that like you get your income tax on a far lower level if you don't pay for them as well, rather than getting your tokens at a later point at whatever the value is, which would be then obviously a higher income tax charge for yourself. Not to take away from Cap, because those are some great questions. Were there questions from anyone else? No?
You're talking there briefly about giving tokens away for free on like a personal level. What's the business implications of that? Like if I'm a business and I say every new user of my platform gets 10 USDC or some NFT or something, I'm effectively giving away for free. Can I count that as a loss, or is there some tax implications on that?
So implications for you or implications for the user? For the business, well, at some point, again, depending on what, which business is holding the tokens and distributing the tokens, but let's say that's UK based, you are effectively making a disposal of tokens for nothing within the business, right? Now, it depends what cost basis you have in the business, but presumably if that was the business that built the tokens, that cost basis may be incredibly low, or it might not even be recognized on the balance sheet as an intangible asset. So actually, there's very little implications for the business itself. For the user, obviously, if they are getting something of value, then that may have income tax implications for them if they're receiving something for free if they've provided a service. It depends how it lines up with what they are doing to receive that as to whether there is an income tax implication on that or not. If that answers your question.
You were putting your hand up.
So my last question is,
Is that a promise?
it probably doesn't have a great answer, but I think I probably have to ask it just because like I just saw it like a chat when we put this in. Well, what's your argument to when somebody says, okay, how should I look at organizing my tax? And they say, move to Dubai and don't pay any.
I die a little inside. That's my answer. That's my answer to that question. It's something I always get. So it's so funny. Like some people are like, "Oh, but what if I just move over to Dubai and I sell it there and move back again?" Doesn't work, right? So again, going back to all of these rules that we have that prevent people doing fun things to not pay tax, is around residency, where you're based, and various other things. So in order to leave the country, dispose of your crypto, and come back to the country without the UK having a right to tax that, you need to be outside of the country for 5 years. Otherwise, you're treated as a temporary non-resident, and effectively, because otherwise they're just like, cool, you've just moved abroad, you've sold all your stuff, you've come back again, you probably only did that to go and sell your stuff and not pay tax, so we'll have it, thanks very much.
Right? We have to know it's 5 complete tax years.
5 complete tax years, indeed.
So, yeah.
So it's not as simple as just escaping. And I guess it depends on your position before you leave. Like if you're up to date with your taxes and then you choose to leave, cool, fab. Like, go and enjoy Dubai. Obviously, so many people are because of the crypto community out there, and no income tax rates on what they're earning, and no capital gains tax on the crypto either. Where was I going with this? I had something
I'm
else
not really sure.
No, me neither. I've lost my train of thought.
Okay, so basically, just to camp into Dubai doesn't necessarily change your situation if you want to come back. Fun thing I would say about Dubai, in 2021, I was meant to be joining, this is on behalf of HMRC, a call with the Dubai authorities. I was banned from saying anything because I was more crypto positive than the people who were in Dubai. The conversation going on in Dubai with the police was the only people who use crypto are criminals. The perception of Dubai at that point was very, very criminals only use crypto. Therefore, if you have crypto, we want to put you in jail, pretty much. The reason why I was banned from saying anything because I was always like, well, where's the criminality in owning crypto? It just in of itself doesn't create the effect. But as you've seen now, it's changed completely. I would always say there's a risk that if you can see such a quick change in somewhere, they could always change back again. They could always go back to that idea that actually crypto hasn't done as well for them as they would like, and go back to that very hard stance that if you own crypto, you're a criminal.
Yeah, and I think where I was going with that is these questions often come about because people aren't up to date with their taxes in the UK. So they think, I've not been found yet, so I'll just jump on that plane, go to Dubai, tee-hee-hee, I'll dance into the sunset. And again, I think there is this perception that HMRC won't find me, crypto isn't traceable. How will they ever know? And that is a question that we do come across quite a lot when we're having conversations. And I feel like that was a nice little prelude into, like, your eyes are even already lighting up with excitement about, go on.
But the world's changing and becoming ever smaller and hiding crypto. So the OECD, so the Organization for Economic Cooperation and Development, has developed the Crypto Asset Reporting Framework, CARF. And with that CARF agreement, round about so far, 60 jurisdictions have signed up to share information on crypto transactions globally. I'm seeing some shaking of the heads from over here. Some people are very not fans of that. That does mean then that HMRC can get information from UK-based exchanges at the moment. It can use international tax arrangements, tax agreements to get information from exchanges offshore. It is harder, trust me, to get that information from a tax offshore. But what will happen with CARF is actually the information will be automatically provided. So an exchange in Canada will be providing information to HMRC automatically starting from the 1st of January 2026, so next year, and every year reporting in 2027 and every year thereafter. So if you think that they're not going to find out about your crypto, it's highly unlikely, certainly going forward. and VARA, the Dubai authorities, are signing up to CARF as well. So that information will be going to HMRC, and VARA will be getting their information from HMRC. So you're not necessarily going to be able to escape it that way.
The worst keeps worsening.
Absolutely, yeah. The world gets smaller and more transparent every day. So I'm just conscious of time, but just one last question from me. Who's actually heard of CARF, the Crypto Asset Reporting Framework? Not you, James. One. So that's quite interesting. So if this had been in the regulatory space, when we were moving to becoming regulated for Fifth Money Laundering Directive, seeing that everyone was talking about regulations, everyone was talking about these type of things that were going to bring businesses these challenges. But because it's tax or CARF, no one seems to be talking about it, even though it's bound to arrive on our doorstep.
But there's an interesting point there, right? Because, and I don't want you to have to talk about those traumatic years at HMRC, but there is, obviously the guidance came out. The guidance. And there's a point here around promotion, and actually sticking it on a website and making it publicly available means that presumably everyone should be expected to go and see it. Like, how would somebody know about CARF in this space?
Yeah.
Like, how? I don't quite. I'm trying to formulate that into a question, and I'm not quite sure
No,
how.
I got where you're coming from. So when you put the guidance out, obviously that was a hard effort, and we actually did a lot of attempted outreach, roundtables, blah blah blah, on stage talking about these things to people. Hence the reason why I've still got PTSD about pitchforks and burning torches. But yeah, it's not an interesting topic for some people. Tax doesn't get the same order of interest than regulation, and everyone would be talking about regulation much more. We've already touched upon some regulatory questions than I think necessarily tax. So I think a lot of people think it's. I don't know. Maybe if I don't talk about it, it doesn't happen.
Yeah, fair.
So we've now come to the top of the hour. So we've actually filled the hour.
Wowzers.
I know, right?
Thank you all for sticking with us.
Yeah, at least in body, if not in soul. So the next step, we're going to be having a session in the Hive. Getting some nods over there, so thank you. We're going to be going up with Alice and James, and they're going to be talking about how can you help manage the data. So the bit that we talked about earlier, we've got an actual presentation, and we've got some interactivity going on there. And Alice is going to then talk also about some of the things that you have to make sure you're doing to stay on the right side of HMRC. So hopefully we'll be seeing you all in the Hive. Thank you all very, very much.
Thank you, everyone.